Okay, welcome back. We're going to jump right into more of the conversation on relative valuation. My name is Patrick Bottolato. I guess you picked it up from this slide. But I did the intro one right before this. Hopefully, you'll be able to check that out. Now, I just want to extend it and talk about some specific things that we see with relative valuation. Now that you have a general exposure to the idea and the math without any application yet. So let's jump into it here. This is my extension. Sorry, I didn't go anywhere yet. There I am. Let me jump into this. So the conversation I want to have right now is on the idea of price to earnings, and this is one of many, in many ways, ways of doing relative valuation. So first, what is it? Price to earnings, or PE ratios, as we do call them. This is going to be like the price per share of a company compared to the earnings per share. And the fact that they're both per share is actually a way of looking at like the company's value on a per share basis compared to the earnings per share. But it really is more broadly looking at the company's value in terms of market cap, or the value of equity, compared to the net income or earnings, which is the total profits or wealth created for the shareholders in a particular period. And so it is exactly the idea of relative valuation. What's the value of something in the numerator compared to the payout in the denominator here? So back to the perpetuity math, we can rearrange our equation, but we're still sticking with the same idea. All right, so what is this? This is a way of looking at the price per share of a company compared to the earnings per share. It is specifically share price divided by earnings per share, as I said. What should we do here? It's relevant payout for market cap, but I would actually argue a limitation of this is just to use literal net income. One of the things which we cover extensively in the financial statement analysis class is that it may not be literal net income that we want to use, because net income, one of the flaws of net income is completeness. It can include one-time or non-recurring items. So a big issue with free cash flows, with EBITDA, with EBIT, and with net income, those are all common metrics that actually share the same common flaw. They all include one-time or truly non-recurring items. And the issue in valuation, now, why is that done in a net income sense? Well, completeness. We're required to depict all the revenue, expenses, gains, and losses in a period. But for valuation, whether it's an intrinsic model where we want to strip them out and not include them in our forecast, or also relative valuation, so that understanding of the granular pieces applies to both. In both cases, we don't want to be basing value on one-time or non-recurring items. We want to be based it on recurring, sustainable aspects of the company. That's true whether it's the modeling in an intrinsic value model, or in this case, actually with relative valuation. So the point I want to make here is we may not want literal net income. We really want what we talk about and refer to as core earnings, which would just be restated more simply as earnings stripped of or adjusting out truly one-time or non-recurring items. Now, to be clear, there's lots of adjustments that are actually adjusting recurring items. That's not what I'm talking about, but truly one time. You have a truly one-time gain. You have a truly one-time loss, right? It's not going to occur again. I want to strip that out. So I may not be using literal net income. I want to look at my core earnings, which is my revenue minus all my revenue, recurring revenue minus all my core recurring expenses, and only stripping out one-time or truly non-recurring items. So that's what I have there. You could argue that's recurring and representative earnings. I kind of covered that a bit. If you were doing that, only applies to market cap, because the market cap of a company is the amount that the market, a publicly traded company, the amount that the market believes that company's total equity is worth. Because net income is a payout from the perspective of shareholders only, if we're thinking about the value of equity effectively in my numerator, I want the payout to match in my denominator. And so using net income, or more specifically, like core earnings, is going to be ideal. What if I was doing a enterprise value calculation? Well, what would my payout be? It's not net income. As I've covered extensively in financial statement analysis class, net income is the wealth created in a period for the perspective of shareholders, not all providers of capital. So if I was to think about enterprise value, we would actually not want to use net income in the denominator. You could use net operating profit after taxes. You should still make sure you remove truly one-time items. As I mentioned before, I'll just repeat it again. EBIT and EBITDA don't actually remove one-time items. So just be extra careful if you start using one of those kind of metrics or approaches. Let me keep this going. There's a little bit more to do here. So let's keep talking about price to earnings ratio or PE ratios. This can be, oh, I see my issue. Sorry. Hopefully you don't mind. I needed to, all right, here's where we're at. I need to make it full slide so I could actually scroll through the next one. What's the payout here? And this is a little bit of a background. And if you've seen these before, you're likely aware of this. Generally speaking, when you see people talk about, or if you've heard people talk about, well, how do you do relative valuation? We're actually we're pretty clear on the first issue here, which is people don't make enterprise value a function of net income for the reasons I just stated, but I want to restate. Net income is not the payout with respect to all the providers of capital. It's just the payout with respect to the shareholders. So you really don't ever want to be making enterprise value a function of net income. That's a mismatch between the numerator, the value we're estimating, and the denominator, the payout we're using. So that's a mismatch. It's fortunately a problem I think it seems like we're very well aware of. So, I don't, in business school applications and professional applications, people don't usually make that mistake. I'm just setting it up to kind of just make sure we're on the same page here. But this is actually kind of interesting, is that go to the other side. Many people still use enterprise value as a function of EBITDA, earnings before interest, taxes, and depreciation. And interestingly, they both have the same issues, which is neither net income nor EBITDA is actually a payout that your investors get. Why is net income not one? Because it excludes interest, but the providers of debt capital absolutely get interest. Net income doesn't work. But EBITDA makes a different mistake, but the same conceptual mistake, which is your investors do not, correct me if there's a scenario this is not the case, don't get taxes. Those go to the government, the U.S. Treasury, and other treasuries of different jurisdictions. They do not get the capital you have to redeploy, when assets get depreciated if you want to stay in business and not go under. So it actually is also, EBITDA is also not a representative payout to your providers of capital. Now, to be clear, the add back for interest, earnings before interest, is totally valid, right? It should be there. It's just that we go a little too far, which makes sense. The more you add back, the bigger it gets, the better it is to kind of show a higher value, and that's our goal. But the earnings before interest, that's the same thing as roughly, not literally always the same thing as net operating profit after taxes. The adjustment for interest is absolutely needed. But we go a little bit further, and I want to talk about how you solve that problem, but just want to make us aware that the issues we have are, I can't just say I'm going to use a multiple or relative valuation equally. Before I use any particular financial metric in my denominator, I want to make sure that there's a natural match between my denominator and my numerator. Net income is not linked to enterprise value because net income is just from the perspective of shareholders, not all the providers of capital. EBITDA is also not naturally linked to enterprise value because EBITDA is looking at a payout that goes to back into the company, depreciation, amortization, and to treasury departments across various taxing jurisdictions. So that's not a representative payout either. Net operating profit after taxes would be your best version of a payout that would go to all of your providers of capital. All right. Next, I'll get into how we solve some of these issues with EBITDA, just so because it's common. So my comment here is I'm not in any way, I think I always have some students who kind of make this comment like, I'm not naive. I know how popular EBITDA is. That's quite literally why we cover it quite a bit, make sure that we understand it, right? It has flaws. It has massive limitations. But the worst thing to do is just to, bow down to EBITDA, accept it wholeheartedly without the time and reflection about how does it work, what are its limitations. Because it's commonly used, right? So, I feel like whenever I teach a class, I'm like, this is really common. I know it's really common. That's exactly why I spend time giving us the first chance in most cases to actually understand how it works, not how it's calculated and what does it stand for. Virtually everybody knows that, when you're hitting an upper level business school kind of class, and surely many before that, to be clear. But it's how does it work and what are its limitations? So seeing it many ways with clear eyes, but importantly, still seeing it. So I absolutely acknowledge the prevalence. That's what I want to spend time on. So we insist, right? I'm just going to argue that, like, hey, society seems to insist this is what it wants to use. Okay, so let me give you a roadmap to how to use it in a way that can undo a lot of the distortions that EBITDA introduces. First, I would say you actually could remove these just by focusing on net operating profit after taxes, but that's less common, so we have to kind of work through this. One, what's your first step you want to do here? You have to remove the one-time items that EBITDA includes. Much like you have to do with net income, EBITDA is excluding interest, taxes, depreciation, amortization. Those are recurring things. And it doesn't include non-recurring one-time items. So we, the user here, have to go an extra step, find them, understand them, determine whether they're one-time or not, and exclude them. All right. Then we have to keep doing more work. But again, it's a solvable problem, just an arduous process. What's the next thing we need to do here? We need to make sure that we reduce the multiple based on expected capital intensity. The easiest way to do this is actually just to acknowledge depreciation and amortization for what it is, which is an expense that represents resources consumed to run your business. Stated differently, just leave depreciation and amortization in there. Don't, segregate it or give the appearance that it's a different expense. Why? What's the basic logic here? Investors do not get the cash redeployed in the business to maintain revenue. And so you have to reduce your multiple. How do you solve that if you insist on using EBITDA, which many will insist on? So let's give that group a roadmap too. You have to decrease your multiple. And Michael Mobison does a great job of covering this point too. You have to decrease your multiple based on capital intensity, or basically all of the cash you have to redeploy to offset depreciation and amortization. You have to reduce your multiple to mathematically represent that, right? This is the same as leaving depreciation and amortization in as an expense, acknowledging that they're core recurring operating expenses related to cash outflows. You could do it by leaving it in, or if you insist on backing it out like EBITDA does, you need to make sure that you actively decrease your multiple for the level of capital intensity of a company. Similar thing with taxes, right? EBITDA is ignoring taxes, backing them out. But the reality is investors don't get paid the cash that we have to pay to treasury authorities, et cetera, for taxes, right? That's the fact that we're working with here. I want to stick with the facts here. So as a result, you could either leave taxes as an expense, which is a use of resources that the investors of all types don't get. Or you could, if you insist on using EBITDA, I want to give you a roadmap too. You just have to mathematically decrease your multiple to offset the fact that the value has to be different for each incremental dollar you're giving to a taxing authority. The value has to be, I said different, lower for each dollar you have to redeploy back in your business. So the logic or the conceptual idea behind reducing the multiple for depreciation and amortization or reducing the multiple for taxes is the same. I'm not saying the mathematical end result of that will be the same. They maybe have high capital intensity and low expected tax burden or tax expense. So you have to understand the company's expected tax burden and expected capital intensity and mathematically decrease your multiple to represent that. Easiest way to do it is not to use EBITDA, but just to leave those things as expenses, consumption of resources, right? The core ideas of accounting are kind of front and center with regular valuation. But again, I'm not alarmingly naive. Other parts of valuation are more about making it inaccessible, hand-waving, and intentionally controlling the narrative, which gives rise to why things like EBITDA are common. So for those of us, what do we have to do? We have to spend a little bit of extra effort to sort of undo the distortions of EBITDA. But it's a solvable problem, right? Just because we're using EBITDA as a multiple in valuation doesn't mean the valuation is wrong, but it does mean we're decided to take on a lot of extra work. But do the work, right? Solve the problem. All right. In addition, you have to do the same thing with all multiples, which is you have to ensure that the multiple captures our expectations of future changes to revenue, operating margins, and risk, the things that drive value. So even when you're done undoing EBITDA distortions, you're not done. You have to still take it one step further. So you can use EBITDA as a multiple. I get that. It is commonly done. Just know that you're signing up for extra work. If that's your thing, go forward, right? Just make sure you don't just use it and assume that it doesn't create problems, because EBITDA impairs comparability, greatly impairs comparability. I've got it, my post on LinkedIn, if you want to check that out, all the ways, intentionally trying to work through the technical problems of it. Because it impairs comparability and because it introduces distortions into the process, you have to do extra work to undo them. But if you undo them, you're fine. You really are fine. All right, good. Next one, you can use revenue as a multiple. So you could argue that the company's revenue times some multiple equals the estimated value. What's the benefit of this? Well, I think there are two here. One, revenue is going to be positive even when other things are negative. And some of the reason behind using EBITDA or other things is that, well, the cash flows or the income could be negative. That's not a good enough reason on its own, although that is actually a problem because you can't do multiples-based valuation if your payout is negative, right? Like that's true. That doesn't mean any payout that's positive is better, but it is true that you can't do multiples-based valuation if your payout is negative, right? So revenue is another thing that can be considered. Revenue is always going to be positive. To be clear, I do have an answer. Do not do relative valuation for a pre-revenue company. So if your answer is they don't have revenue yet, fine. Do not do relative valuation, right? There is no metric that's going to work here. There's no piece of financial information you can use yet. You can value the company. It's extremely difficult, extreme uncertainty, but you can't take an item of financial information if it truly is a pre-revenue company, right? Just to lay that out here. So what if that's not that many companies, but it does happen? What if they have revenue? Well, revenue is always going to be positive, so it could work, but we're still not done. We have extra work to do here. Specifically, while it is not revenue like EBITDA is not a representative payout. They don't get revenue. Revenue is offset with expenses, effectively, the outflows of cash. So work can be done to solve this problem. First, most importantly, you have to change the multiple to figure out like expected expenses. If you think it's going to be a high margin company, they should have a higher margin. You expect to be a lower margin company, they should have a lower margin, right? What the end result is, should Microsoft have a higher? I'm not saying these are undervalued companies. I will give this comment though: should Microsoft have a higher multiple of revenue than Walmart? Yes, it should. Why? Microsoft or Apple's margins are significantly higher than Walmart's, and they likely will be absent a business change. So, if you're reading this and the whole business change, that's different because Microsoft has had and will have much higher margins than Apple. So then I said that wrong, than Walmart. And as a result, if we were valuing them as a function of revenue, we absolutely should give a Google or an Apple or a Microsoft a higher multiple of revenue than we should a Walmart. All those are well-run, companies. I'm not saying they're over or undervalued in any way, but you can't just lump them all together. You can't use the exact same multiple, right? If you know they're going to have fundamentally different margins. The Microsofts, the Googles, the Apples of the world, generally speaking, having higher operating margins. The Walmarts of the world, very well run, but still low margin companies. All right. Costco, Walmart, I put them both in that group. They just should be valued at a lower multiple of revenue. All else held equal. All right. So next thing here, expected future revenue growth, which is really my comment for all else held equal. Well, you're really looking at both of these. So if you expect a company to have lower expected revenue growth, they should have a lower multiple. If you expect them to have higher expected revenue growth, they should have a higher multiple. So in all these multiples, we're still getting at the core drivers of valuation. Revenue, or really revenue growth, not revenue on its own, and margins or operating margins. And so you have to adjust your multiple if you're doing revenue. Revenue is going to be positive. You cannot use the same multiple. You have to first consider expenses. Less expenses, which is the same as higher margins, higher multiples should be used. And you should consider expected revenue growth. Higher expected revenue growth should be a higher multiple. Lower expected revenue growth should be a lower multiple. So in all these cases, multiples are good. They're valuable, but they don't give us specific answers. They just sort of make sure that we're thoughtfully considering what's happening and how do we work through it all, and including in the fundamentals of the business about revenues and expenses. All right, I actually skipped a slide here and I need to go back to it. I probably shouldn't have made this mistake, but we just did a conversation on a bunch of them. And I think it's fine. You need to flip back in your slide deck if you're looking at this hard copy. But to now actually jump into a little bit more of an application. So my slides are out of order. Hopefully this isn't a problem. What if let's just have a conversation with using PE ratios, but actually the idea extends to any multiple with the caveat of those extra things we need to do. Generally speaking, PE ratios are like 20 to 25 or actually 17, high teens to 25, basically. So I would just want to have this conversation. Say you're running your screen or your analysis, you're looking at a company and you say, hey, they only have a PE of 10. And the evidence shows that companies on average usually have a higher PE than 10, meaning that the share price is greater than the earnings per share. And specifically, like let's say the share price was 20 and earnings per share were $2, that would be a PE of 10. All right, price to earnings ratio of 10. Before we conclude this company is undervalued, even though its PE ratio is on average lower than companies usually sit at, there could be a fundamentals-based reason behind this. It could be undervalued. I want to be clear, right? That's what multiples can tell us. But before you conclude that, I just want to emphasize it could be correctly priced and indicate that either future growth, revenue growth, or margins are expected to be lower. So why should the market be willing to pay less for something per dollars of earnings? What if its expected margins or revenue are lower than the average market participant? It should be valued at a smaller amount. So its multiple should be lower. When you're saying, if we were to say that it's got to be the same as on average, you're saying that its margins and its revenue, in this case, future margins, future revenue should be the same as, I'm talking about future expectations here, should be the same as everybody else. But a reason a company should trade at a lower multiple is if the future revenue growth and the future margins are expected to be lower. Right? A PE ratio of 35. Is that an overvalued company? Well, maybe, but also maybe not. Why maybe not? Well, it could be that the market is correctly pricing expected improvements in revenue growth or expected improvements in margins. And as a result, the market is, the value is not overvalued. It's simply reflecting that there's expectations of stronger performance on fundamentals relative to other companies. So in both of these, the other reason is it could just be that there's one-time items in there. So make sure you're aware of that first. Not like artificially make earnings too small or too big. I just want to add that in. That's actually across both of these. But use multiples to screen, to get a good look at a company, to think about what's going on. But never with the conclusion that just because it's different, there must be a mispricing. No, but it's a great starting point for mispricing. Is it over undervalued? Or is it correctly priced because the expectations of the future are different? All right, let me begin to wrap this up. I think I have one more slide at the end. I want to go back into that. This one, really the same idea and not a whole lot different than the application we just did with those different price to earnings ratios. It only works, we can truly assume that future growth, operating profitability, risk are all held constant. If not, that this approach to valuation can be quick and dirty. So I'm not saying don't do it, but just know its limitations. I mean, actually, I would say do it, but know its limitations. So fundamentals, it's the same thing with intrinsic value, right? The big thing we emphasize in our class is how do we understand fundamentals, things like the opportunities to grow revenue, the opportunities to expand margins. Those are the primary drivers of cash flows. Those are the primary drivers of value. There's lots of hand waving. I'm doing it here myself, right? With valuation. Let's talk about complex terms. Let's make it inaccessible. Let's, use extremely complex acronyms and formulas. That's fine. I'm not saying don't do that. And of course, I understand that that's the norm. That's the status quo. But behind all of that, right, my huge bias is not to train more people just to be financial alchemists, but to see and reflect business reality. Big bias is that what's the big goal of valuation? Well, we as a society are better off if capital goes to the best projects and away from the worst ones, right? I'm not looking to, this is like wishful thinking. We're all better off if we don't finance the next crazy fraud and we finance the next great innovation. And so what does that mean? It's not just about being a financial alchemist. How do I mislead? How do I deceive? How do I give the appearance of doing due diligence or the appearance of doing valuation? Whether it's intrinsic value models or it is relative valuation, I'm assuming and I'm hoping, and I'm completely biased, we're all after the same goal. The better and more thoughtful we are about understanding fundamentals of a business, the better we can do at doing valuation, the better we see the link between accounting and finance, and these are not separate silos, the better we can do valuation. How are we better there? We're better the more granular, the more understanding of the business we have, the more understanding of the mapping of what drives value. No matter what metric we use, that's what we're focused on. So what's the benefit of all that? Well, hopefully you share the idea that the allocation of capital matters, and we as decision makers at different times get to influence that. So what's the goal here? Not to teach us to become financial alchemists. How do we give the appearance? How do we paint rocks and lie to people that they're gold? I'm also not naive to think that doesn't happen. Of course that happens. That can be very lucrative for some. But still, the economy is not going to move forward unless we have individuals thinking about what about actual company value. The difference here is between value creation and value extraction. Right? Value extraction is I got my piece, screw you. Value creation is, hey, how do we move this whole thing forward? So that's a fun way to think about valuation to wrap this all up. With that, I'm going to end this one. That's the coverage on relative valuation with some extra commentary broadly about valuation at the end. Take care. Hopefully this was useful for you.